So in short, there's not really been any major change in the trust positioning and focus over the period. This trust has been focused on the European mid-market principally for 21 years, and it continues to be that way oriented. If we look at the portfolio right now, and it's very concentrated in northwestern Europe, so more stable economies. The UK is the largest single country exposure at 18%, but pretty well balanced with countries in the Nordics, Germany, France, and actually North America as well. We've got around 20% of exposure over there as well. And in terms of sector, it's pretty well diversified and balanced. So technology is our largest exposure at 21% of the portfolio, but then pretty well balanced beyond that amongst healthcare, consumer, industrials, and financial services as well. And we don't try to market time in this trust. Quite the opposite. We maintain a pretty consistent deployment over a period of time. And that's why you see in terms of our underlying investments, the maturity is pretty well balanced. Around 50% of the book has been held for 4 years or more. So that helps underpin good realization, exit activity, and cash coming back to the trust. Probably the key thing to point out would be something that I've pointed out over many quarters now. We introduced co-investments to the investment objective back at the start of 2019. And co-investments are direct investments into underlying portfolio companies alongside a lead private equity investor, and they bring a number of advantages for the trust. Most notably, they tend to command less fees or carried interest, or in fact no fees and carried interest in some cases. So it reduces the look-through cost of the trust, and should, if we get our selections right, and we believe we have, provide a good tailwind to performance over the long run. So co-investment has increased in the period to 18% of NAV. At the start of the financial year, it was around 11% of NAV. So good progress there, and we're delighted by the performance so far in that space. So the trust released its 31st of August monthly NAV statement recently, and that's the first period where we have seen valuations at the 30th of June being incorporated into the portfolio. As you know, private equity reports quarterly, so there tends to be a valuation lag relative to public markets. And we saw in that month an increase of 3.3% over the prior month. Now, around 3% of that is FX due to the depreciation of sterling relative to euro and particularly US dollar. But 0.3% of the uplift was underlying portfolio valuations increasing. So we're delighted about that performance in a market which is very difficult right now. I think we view that as strong performance, relatively speaking. So that takes our net assets to around 1.1 billion now in the trust. So there's a good scale in the trust relative to a few years ago. So very pleased about that. And distributions continue to come in. So in the 11 months to 31st of August, we're at distributions of around 193 million, which compares pretty well to prior year, which was a record year, in fact. So the 12 months prior were distributions were around 198 million. So we're pretty close to that record distribution level, which is very pleasing and helps sort of provide cash back into the trust to underpin further new investment activities. So another good area of performance so far this year. So at a portfolio level, as I mentioned earlier, there isn't that much to report during the period. I think it's a relatively stable portfolio, as I mentioned, and we don't try to market time. I think probably the key development during the period is that the trust has increased its revolving credit facility in size from 200 million to 300 million, and also pushed out the maturity for another year to December 2025. So we're really, really pleased about that. An extra 100 million for new investment activity in the context of a very, very difficult market as well, providing that a nice insurance policy should things sort of further dislocate in the financial markets in the near term. So yeah, very positive development on that front. So I'm actually going to revisit two companies that I've talked about before, just because of how well they've started and the developments since we invested. So if I start with European Camping Group, now this is a business that we co-invested alongside the lead private equity investor PAI Partners, who have a strong track record in this space. So at the outset, we thought this is a really interesting way to play the recovery in travel post COVID, and we thought it was a really interesting entry valuation as well. In addition, the opportunity here is quite vast. It's a fragmented market. It's campsites essentially across Europe, and a lot of these campsites are locally owned. So there is a big buy and build opportunity, and that was really our investment thesis. Now the company has started very, very strongly out of the gate, so we're really pleased about that on our organic basis. But the big development here is it recently announced the transformative acquisition of its peer, Vacon Select, a very complementary business which really brings an awful lot of scale to the combined business, and there's a lot of synergies between the two businesses as well. So a big opportunity there to actually increase the return potential of this investment, which was already ahead of our plan prior to the acquisition taking place. So that's one that we're super excited about. In addition, I would mention ACT. This is a business that the trust has partnered with alongside the management team and the lead private equity investor, Bridgepoint. It's headquartered in the Netherlands, but it's very much a global business. And what it does is it provides environmental certifications to corporates really across the globe. Corporates that require to give certain attestations around their climate impact. So that might be businesses in the aviation sector, but also businesses that want to voluntarily do so and prove their sort of carbon neutrality, for example. And so this business is very much topical right now. And the performance so far during our hold period has been exceptional. And last year's earnings were close to double what was forecast at the outset of our investment. So one that's performing very, very strongly organically. And there is, again, a sort of M&A buy and build component to this as well. So two very exciting positions in the trust, in the co-investment book specifically. So if I break our portfolio down into the sort of three key pillars, which would be primary fund investments, co-investments, and secondary investments. If I start with primary fund investments, so there really is no change here. We're continuing to back what we believe to be best-in-class managers with whom we've had a very long-term relationship. They're sector specialists, really, because that's where we believe the opportunity will be as we look ahead for the next 10 years. Sort of those managers that really know a small part of the market really well, like a trade buyer. And then typically we've been moving more to the lower end of the mid-market in primary investments as well, because we think there's been less capital raised there relative to the large cap space. So none of that's changed really in terms of focus. But if I look to co-investments and secondary, so co-investments firstly, we're at around 18% of NAV at present. I would guide people to co-investment growing to around 25% over the medium term. We've got 22 co-investments at the moment. We hope to grow that portfolio to a portfolio of around 25, 30 co-investments over that medium term period. So, and as I mentioned earlier, the advantages of this is that it gives us so much more control over cash. They're less expensive relative to fund investments. So the look-through costs benefit, and then hopefully performance as well benefits if we get the selections right. But lastly, secondary investments, I think, is the area that we could see a real uptick in activity. So the trust has been quite quiet recently around secondary investments. There hasn't been that much happening in the market in the first 6 months of the year. But as we look ahead, we think there's the likelihood of us seeing more distressed sellers, people suffering with the denominator effect because of the decline in public markets. The probability of that is higher. The likelihood of that is higher. So we may see more deal flow there that fits with the trust's appetite and investment objectives. So We have a secondary team of around 8 investment professionals that are really well positioned to take advantage of any opportunities that comes the trust's way. So we're excited about that as well as we look ahead.